Greetings, Ted Hicks, founder, CEO, and Chief Investment Officer for Hicks & Associates Wealth Management. Today is Monday, March 7th, and I wanted to highlight something that we talked about in this month's monthly market monologue. And in particular, I want to give a little bit extra color to this particular chart. This is the S&P 500 from 1965 through 1979. That is a 15-year time period, and many would agree that is a long time. So in this industry, you often hear that you should be invested for the long haul, be invested for the long term. And to some extent, the message is frequently, ride out the short-term volatility because in the end, the market is up. Well, this is a long time horizon, 65 through 79. And this is not hypothetical. This is actual U.S. stock market history. This time period, 1965 through 1979, if you did the math without adjusting for inflation, which we're going to show you in just a second, the market was up about 2% on average. But again, as you see on the screen, that was not an average time period. This is a very volatile time period. So we also know that 65 through 79, there was a lot going on. There was the Vietnam War, there was a Korean conflict, and there was also a high inflationary time period. Well, what's going on now? Now we have a war in Ukraine. We have high inflation. In fact, the highest inflation we've seen in 40 years. So what we're trying to show here is, let's look at this after we adjust this for inflation. This is the same chart, just adjusted for inflation. Okay. What would that do to your portfolio if that type of environment happens again? We already know we're in a high inflationary environment. I obviously have no foresight to what's going to happen over the next 10, 15 years, etc. But have we stopped to consider how we would adjust the portfolio through a time period like this? Because you probably are still investing through, we're still investing through this time period, but how we invest is different. Now we take a look and we add 2 more years, because 65 through 79 is just 15 years. It's somewhat random, but if we extend that view out 2 more years to 1981, we see that, again, now we have a 17-year time period where the market was overall trending down once you adjusted for inflation. And so how does that work out? I've just added the price measures in terms to show you the bear markets, but I would argue that's a 17-year long bear market once you adjust for inflation. So something we take a look at. This is definitely colors how we invest our clients through a time period such as this. If you want more details, obviously feel free to reach out to me. I'll leave my contact information on the screen in just a second. But we also want to give a plug for a charity bike ride that we're going to be participating in. I'm putting together a cycling team for the V Foundation Victory Ride to Cure Cancer. I do have spots on my team. If you are a cyclist, feel free to reach out to me, let me know you'd like to join us. Otherwise, if you would be so kind to consider making a financial contribution to our fundraising goal, we would appreciate it. And 100% of the proceeds of this charity ride go directly to cancer research. Nothing goes to the V Foundation overhead, which is pretty impressive, but it's true. So I will put the link in the comment section below. If you'd like to make a contribution, we would be forever grateful. Again, we hope this helped. If you have any questions, feel free to reach out to me and my team. It would be an honor to serve you. Again, you do not need to be a client in order to ask us a question. We would be more than happy to help you in any way that we possibly can. In the meantime, thanks for watching. We'll talk to you soon.